Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, we need to talk about what's happening with Polar Power Inc. That's ticker POLA. And this really isn't a typical microcap situation. This is, well, it's a very time-sensitive, high-stakes setup that's all anchored to the stock's current price, which is floating around $1.80. That price isn't really about value. It's more a function of some very peculiar market mechanics.
And those market mechanics, as intriguing as they are, they're happening to a company that is fundamentally in the final stages of a financial collapse. So the question we have to ask, and it really is a binary one, is this. Is PLA an asymmetric special situation? A technical glitch that's about to rocket fivefold to $9 or $10? Or is it just a fundamentally distressed company with say, a 60% chance of its equity getting completely wiped out, sending the price to 20 cents or even zero? I have to argue that the fundamentals point squarely to that latter conclusion.
And I completely get the gravitational pull of those grim fundamentals, I do. But my position is that we're looking at a brief, maybe even a violent exception to that rule. You have to see the difference between the shares outstanding, which, are already low at 2.66 million, and the effective trading flow. The effective flow is what's actually available to trade, once you strip out insiders, strategic holders, long-term funds. For POLA, that number is it's alarmingly thin. It could be as low as 1.2 to 1.5 million shares. That scarcity is the engine for this thing's wild, unpredictable moves.
And I would argue that any thesis built on float scarcity that just, willfully ignores an imminent liquidity crisis it's not investing, it's pure speculation. The basic physics of cash flow will eventually drag that price right back down to its intrinsic value, which is probably zero.
See, my argument isn't about long-term value at all. It's about a structural opportunity. It's an asymmetric special situation. This just means the potential reward is far, far greater than the risk you're taking, even if the probability of it working out is low. My whole position is that the chance of a real sustainable turnaround is tiny, maybe less than 10%. But the structural probability of a violent spike upwards, driven by nothing more than a supply-demand dislocation, that's moderate. Let's call it 20 to 30%. And that non-zero chance makes the setup irresistibly asymmetric, as long as you have strict risk controls in place. The evidence for this is all in the market structure. So we mentioned the ultra-low shares outstanding, 2.66 million. Now look at the pressure on the short sellers. The short interest is sitting at around 75,000 shares. Now that sounds small, right? But then you look at the days to cover, which is currently a whopping 4.29 days.
Okay, hold on. We should probably unpack that. For anyone less familiar with the mechanics, why is a 4.29 days to cover figure like a ticking clock?
Right, good point. So days to cover, or DTC, it's a measure of how many days it would take for all the current short sellers to buy back their shares and close their positions, based on the stock's average daily trading volume. A normal liquid stock might have a DTC of, less than 1. When POLA's DTC hits almost 4.3, it means if some sudden good news hits and the shorts panic and try to cover, it would take them over 4 full days of typical trading volume to get out. The simple physics of that much buy demand hitting such a tiny supply, it guarantees a vertical price move. That's a short squeeze. And what's more, short sellers are paying a fortune to maintain these positions. The borrow costs are high and rising, sitting around 14.43% right now. That fee is a constant tax on them. It's bleeding them dry every single day, increasing their stress. The whole bull case, the one that targets $8.50 or $9, it just needs one moment, one piece of good news, like that Tier 1 contract getting renewed, or some expanded military validation, colliding with these squeeze mechanics, and you get panic covering.
I'll grant you the technicals. The high DTC, the borrow fee, that is a difficult spot for the shorts. I get it. However, those constraints are completely secondary to the near certainty of fundamental failure. Any technical spike is just going to be a short-lived distraction. The company is mathematically heading for insolvency. Let's walk through the operational collapse that justifies this fear. In Q3 of 2025, net sales were, what was it, just $1.3 million? That is a precipitous 74% decline year over year. In manufacturing, with all its fixed costs, a 74% revenue collapse is an absolute catastrophe. And you can see the results right on the income statement. They reported a negative gross margin. A staggering $2.26 million gross loss in Q3. They are literally losing money on every single unit they sell, even before you factor in overhead.
Yeah, that negative gross margin, especially combined with that kind of revenue drop, it's genuinely alarming. It signals a complete loss of pricing power, of scale, of everything.
Exactly. And that distress forced them to take a massive $1.97 million write-down on their inventory, specifically on those Toyota engines they had stockpiled. This wasn't just some accounting trick. It permanently weakens their balance sheet. It reduces the book value of the very assets they could have used for collateral. But the most existential threat, the real killer, is liquidity. Their cash reserves are currently below $500,000, and based on their cash burn from operations, which was $590,000 in Q3, they have a runway of less than 1 quarter. The auditor sees this, which is why they issued a going concern qualification.
And could you just elaborate on what a going concern qualification really means? It sounds technical, but it's a critical red flag.
It's the financial equivalent of a fire alarm going off. When an outside auditor issues a going concern notice, they are formally stating that they have significant doubt that the company can even continue to operate for the next 12 months. It is an official acknowledgement that, based on the current numbers, the company is likely headed for bankruptcy unless there is immediate, drastic action. And on top of that, they're already in technical violation of their loan covenants with Pinnacle Bank. So an asymmetric spike is completely irrelevant if the bank calls the loan or the company just plain runs out of cash next quarter.
And that brings us right to the core of the disagreement, doesn't it? It all centers on that single Tier 1 customer, because that right there is the definition of a binary event.
So how can you possibly justify even a small speculative position given that extreme customer concentration risk? This one Tier 1 telecom customer was 63% of their Q3 sales. Their contract expires in December 2025. I mean, that's basically right now. And the huge drop in sales this year strongly suggests this customer is either scaling way back or just walking away. If that contract isn't renewed, the majority of their remaining revenue is just gone. Insolvency becomes immediate. You can't run a manufacturing company on zero revenue.
I agree. Losing that contract is the nuclear option for the stock. It's the high-stakes poker game that's playing out this quarter. If that's gone, the entire thesis dies on the spot. But if the legacy telecom business is drying up, we have to look at the specialized, higher-margin opportunities they're trying to pivot to. We have to look past the telecom failure and focus on 2 areas that might still validate the technology. First, that $674,000 military contract, it's for lightweight DC generators for mobile applications. It's small, sure, but it's critical validation. It proves their engineering is still relevant in niche, high-performance markets where the giant conglomerates can't really compete. Second, and this is highly speculative, is the potential pivot into the 30-kilowatt mobile EV charging market, using their unique DC power architecture for roadside assistance. If they can just land a pilot program with a major network, that story, that pivot to high growth, could instantly overwhelm the current distress and trigger the very squeeze we're talking about. It's a lifeline.
That's a compelling story, a compelling narrative. But let's really scrutinize the tech premise you're defending. Why has the market rejected their core technology for the last few years? You talk about the DC advantage.
The DC advantage is, at its core, simple. They generate 48-volt DC power natively. Traditional generators make AC power, which then needs conversion systems, rectifiers, automatic transfer switches, or ATS, to power a telecom site or charge a battery bank. POLA's tech eliminates all that expensive, inefficient conversion equipment. So in theory, this lowers the total cost of ownership and increases the mean time between failures because you just have fewer complex parts that can break.
I understand the theory. Their generator cuts out the middleman conversion box. That should mean better efficiency and reliability. But why hasn't it worked in the market?
The answer is twofold, and it all comes down to CapEx versus OpEx. First, the scale of AC generators. Global giants like Generac and Caterpillar operate at such an immense scale that they can build and sell their hardware, including the converters, so cheaply that it just completely offsets Polar Power's efficiency gains. In short, the upfront capital expenditure for a traditional system is just lower, and that beats POLA's promise of lower long-term operating expenditure. Second, the market itself has fundamentally shifted because of battery technology. The widespread use of sophisticated lithium-ion battery energy storage systems BESS now provides hours of backup power instantly. This has relegated the generator to, well, a tertiary role. It only runs during really long grid outages.
So if a generator only runs 50 hours a year, the operator cares a lot less about fuel efficiency, or OpEx, and a whole lot more about the upfront capital cost, the CapEx. And POLA consistently loses the CapEx battle. Their efficiency advantage only matters if the generator is running constantly. And that's just not the world we live in anymore.
Market has generally chosen the cheaper, good enough AC solution, especially as BES got better. I'd frame it a bit differently, though. The tech hasn't been rejected everywhere. It's just been pushed into very specific niches, like those mobile military systems or extreme off-grid sites where fuel logistics are a nightmare and the efficiency savings really do matter. But let's pivot to valuation, because this is where the asymmetry is just so clear. Even with all the distress, a price-to-sales ratio of about 0.6 is demonstrably too low. When you compare this to peers, even other struggling microcaps, like, say, Expion 360, which trades at 0.9 times sales, there's a clear technical undervaluation. And that discount, in a market with such a tight supply of shares, it suggests an inefficiency that momentum buyers could exploit very, very quickly.
See, that's where I have to push back. I just don't see that PS ratio as anything other than a textbook value trap. That discount isn't inefficiency, it's completely warranted. You can't value a manufacturing business with negative gross margins, a company losing money on every sale, using a standard revenue multiple. The PS is 0.6 because the sales are down 74%, and the market is pricing in the high probability that those sales are headed to zero. And even if they do somehow survive past Q1 2026, this whole discussion about a technical squeeze ignores the giant, looming reality of dilution, which completely kills the 5x return thesis. To solve that liquidity crisis, they have no choice but to raise money through equity. They can't borrow more. They're already in violation with their bank.
Dilution is, it's the single biggest counterweight to the squeeze thesis. It's the structural death knell for it.
Precisely. We have to look at the base case scenario here. A hugely dilutive capital raise. If the company is forced to, say, double its share count to 5.3 million just to keep the bank happy and fund operations for another year, that flood of new shares completely destroys the scarcity you're betting on. Even if the business stabilizes a bit, that dilution would likely result in a stable but price-destroyed value of maybe $1.20 a share. The share count explosion kills the very mechanism you need for that vertical spike.
I acknowledge that any dilutive raise is an effective kill shot for the squeeze trade. But the squeeze is all about timing. If the technical pressure forces a spike before that mandatory financing hits, an investor could get out with a profit before the dilution crushes the share price.
But that means timing the market with incredible precision, which is always a dangerous game. And on top of that, there are structural sell-off risks here that have nothing to do with the fundamentals, risks that could drive the price below that critical $1 mark and just pin it there.
Right. We know POLA's correlation to the S&P 500 is incredibly low, something like 0.07. So it's not a general market downturn that's the threat. What are the structural risks you're most worried about?
The two big ones are a NASDAQ delisting and so-called toxic financing. If the stock drops and stays below $1 for too long, NASDAQ will delist it. To fix that, the company would likely have to do a value-destroying reverse stock split. That's where, say, 10 shares are consolidated into one just to artificially boost the price back over $1. Shorts love to see that because it signals desperation and almost always comes before another leg down. The second is toxic financing, which is far more insidious. If they take on convertible notes from certain types of lenders, those notes often have conversion prices that are tied to the stock price.
This structure literally incentivizes the lender to short the stock and drive the price down because that lets them convert their debt into a huge number of cheap shares for a quick profit. It creates a self-fulfilling death spiral that can drain the equity to zero, no matter what the company is actually doing operationally.
I understand those risks completely. They're the structural landmines in this trade. But they're also why this is strictly a lotto ticket profile, a small, highly speculative allocation. The potential reward of a technical squeeze driven by the severe scarcity of the float and the panic from shorts who are hemorrhaging cash on that 14% borrow cost, it is so disproportionately high that it warrants a speculative bet. It's a bet on market irrationality, which is created by these unique technical constraints. In the microcap space, that can be a viable strategy if and only if an investor has a defined, strict exit plan tied to a specific catalyst, not just hoping for a miracle.
Viable, perhaps, but I'd say overwhelmingly improbable when you weigh it against the fundamental certainties we've laid out.
Which brings us to the final summary of what is an incredibly complex situation.
My position really hasn't changed. The overwhelming weight of the fundamental evidence, the impending contract expiration in December, the $4 million net loss in Q3, the negative gross margins, and the non-negotiable need for a massively dilutive financing in early 2026, all of it means that reality is going to crush this technical speculation. The company is in survival mode, and survival will almost certainly come at the permanent expense of common shareholders. Betting on a technical spike is betting that market euphoria can outrun the CFO's dwindling cash balance, and historically, that is a losing wager.
And I agree that insolvency is the most probable outcome. Statistically, it's probably a 60% probability. However, the unique market structure, that punishingly high cost to borrow, and the ultra-low effective flow create a non-zero asymmetric possibility, a 20 to 30% chance for a spectacular short-term price dislocation. This is exactly the kind of setup that traditional fundamental analysis is designed to ignore. Yet it's precisely why these kinds of stocks can deliver 5x returns in a matter of days. The risk is immense, but the potential payoff is explosive, and I believe justifies a very small speculative position.
Ultimately, the listener has to weigh the certainty of that financial distress against the technical anomaly created by that incredibly tight float and the high pressure on the shorts.
And the entire thesis for both sides hinges on the binary nature of two imminent deadlines: the Tier 1 contract renewal happening now in December 2025, and that Q1 2026 cash deadline. That outcome defines whether this is a guaranteed loss or an exceptional opportunity. There is very little ground in between.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.